This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to another deep dive podcast from AJ Bell Money and Markets. I'm Laith Khalaf, and in this episode we're going to be delving into the investment strategy of Warren Buffett, the world's best known and wealthiest investor. We're going to be taking a look at how Buffett has achieved his exceptional returns over a career which spans 7 decades, and we'll also be considering how you can apply his principles to building your own portfolio. We'll be talking to Keith Ashworth-Lord. He's the manager of the Sanford DeLand Buffettology fund, and talking to him about how he applies Warren Buffett's techniques to picking companies from the UK stock market. Joining me on this journey through the world of Warren Buffett, I'm very pleased to say I'm joined by AJ Bell's investment director, Russ Mould. Russ, welcome to the pod.
Thank you, Laith. Lovely to see you.
So, let's kick off, shall we? A quick look at the investment returns achieved by Warren Buffett. So since 1965, his investment company, Berkshire Hathaway, has returned 19.9% per annum, compounded over that period. That compares to the S&P 500, which has returned 10.4% a year over the same period. So roughly he's doubled the market return over that obviously very long period. And just to put that in a little bit more context, $100 invested in 1965 would now be worth over $5 million. So Russ, Buffett is 94 years old now. He's been investing for over 7 decades. Do you think that his longevity and that track record make him the greatest investor of all time?
It's a record that's going to take some beating. And I think there are people out there who've got tremendous reputations. Paul Tudor-Jones, Stan Druckenmiller. So there are legends out there, and they're all worth listening to. They all have their different styles, but yeah, Buffett's record stands the test of time. And a lot of people get frankly sick of hearing him or hearing about him. He's a pretty modest guy; he doesn't blow his own trumpet. But a lot of people get sick of hearing about him and are very quick to point out the years when Berkshire Hathaway underperforms or the periods when it underperforms. But he's very open about that. He says, it isn't going to work every year, and he doesn't really care. He doesn't switch the screen on every day and stress about it. And the long-term record sticks for itself. He has a discipline, and he's kept to it. Having said that, he probably did change his style over time, encouraged by his long-time business partner, Charlie Munger. He probably started off by his own admission chasing what he called cigar butt stocks, things that were really, really cheap. You find a cigarette butt on the floor, there's one puff left in it. You paid nothing for it, you've got one puff, you've done well. But I think Munger tried to shepherd him away from what you could maybe argue would be deep value stocks towards better businesses that you were still able to find at a very, very attractive price. And I think, if anything, over time, he's probably been a bit more of a buyer of really good franchises at sensible or occasionally artificially low prices, rather than just somebody who's picked up anything that was potentially knocking around going cheap. So maybe his style changed a bit, but it's been highly effective. And besides his investment style, his writing style was a joy. His shareholder letters were also fantastic to read.
Yeah.
Informative. And not just about investment. All of it was about life. When he was asked what he felt the best investment advice he could give was, it was invest in yourself. Get to be good at it, because it can't be taxed and it can't be taken away from you. And it's pretty good advice, actually.
Yeah, I think that's right. He's plowed out, hundreds of thousands of words, and he's been hugely influential on other fund managers, of course, as well. Probably not least, in the UK, managers like Nick Train and Terry Smith, who are two of the best known fund managers in the UK at the moment. In terms of his investment vehicle, Berkshire Hathaway, you can buy that on the market. The B shares cost around $500 a pop. A shares currently trading at $730 a share. You got any of those in the Russ Mould portfolio?
I'm not allowed to own or choose anything in which I invest, Laith, because I'm doing this, and I don't want any of our viewers or listeners to think that I'm buying something and then ramping it and pumping it and dumping it. There's enough of that goes on illicitly anyway, so they certainly won't meet that anybody to even think that we're doing that. All of my money's run on a strictly discretionary basis. Fair
enough. Those trackers for you. We'll come back to trackers towards the end of the show. But Berkshire Hathaway, it's currently worth over $1 trillion. It's one of the 10 biggest stocks in the S&P 500. It's got about 180 operating companies in it. around 40 listed stocks and $300 billion in cash. What on earth is it? Because it's kind of a conglomerate, it's kind of an investment trust. It's obviously kind of Warren Buffett's investment vehicle. What do you think, Russ?
I
What's the
think
best way to
ultimately,
characterize it?
yeah, I think from a strictly investment point of view, as you said, you can buy shares in it, and therefore it's effectively a closed-ended investment trust. I think is the simplest way of describing it. It gets a huge cash float from the insurance business, from the premiums that it generates. It then has its industrial assets and investment assets, but it's effectively an investment trust with a broad range of, as you say, a broad portfolio, assets of what, 1.1, of about $650 billion, stock market capitalization of just over $1 trillion. And if you look at the mix, as you said, $350 billion in cash, $15 billion in fixed income, $264 in equities, and the rest is then the insurance and the operational businesses. And the operational businesses are everything from railroads to energy utilities to oil companies to chocolatiers. See's Candies, one of the best investments ever made back in 1972.
So what are you buying, Russ? Are you buying Warren Buffett?
I think this is the issue we're about to find out. His long-term business partner, Charlie Munger, passed away a couple of years ago. Buffett's going to step down this year, so Greg Abel's going to take over. And I guess that's probably the biggest question now. And from, just a purely investment perspective, you mentioned that figure of the market cap of around $1 trillion, net assets of $656 billion, you're paying a big premium to NAV. So therefore, there must be an element, you would think, of the Buffett factor in there of what he would do with those assets and how he would deploy that capital and that liquidity with his team, Munger, Abel, Todd Coombs, who's been there for a long time as well. But I think that's one of Greg Abel's biggest challenges is following a very, very difficult act to repeat.
Yeah, okay. Well, I think that kind of tees us up nicely to talk a little bit more about the actual investment strategy that Warren Buffett implies. And you've touched on this already, Russ. He's often referred to as the world's best value investor, largely because of that initial, as you say, approach of cigar butt investing in companies that were down and out. Berkshire Hathaway was initially one of those, wasn't it? The textile business that he bought because he thought he had one last puff in it and became this, huge conglomerate of and vehicle for Warren Buffett. But it's not fair just to characterize him as a value investor, is it? I mean, I think Charlie Munger, moved him away. I think Warren Buffett has actually said this, from trying to, invest in fair companies at wonderful prices to actually investing in wonderful companies at fair prices. So where do you see how his investment strategy fits in terms of the value and growth spectrum that we often talk about so much?
I think they did move away from what you would call deep value to probably almost perhaps growth at a reasonable price. If you were again looking for labeling, I think he'd probably push back on any labels. I mean, I found that with that quote, are growth and value separate? No, he argued that they were joined at the hip. What is investing if it's not the act of seeking value that at least is sufficient to justify the price that you're paying? And Munger said, it's all intelligent investing is value investing, acquiring more than you're paying for, whether it's growth or no growth. So I think they would probably push back on all of those a little bit, that sort of bifurcation. In a way, you may be able to pick up something cheaply, but if it's not going to grow, is anybody else going to want to come and show any interest in it? Possibly not. So I think that the two are together. I think his real skill was being patient, and the real skill that he had was buying at a price that provided some downside protection if anything went wrong, say on a market-wide basis, maybe not just a company-specific basis, but left you with upside potential if things went right. And if you look at, we mentioned that $350 billion cash pile, he's run up, that's a record percentage of the total assets of the business, by the way. So he's still investing with great patience, even though he's 94, which is probably a lesson for us all. He's not changing his disciplines now. And I think if you look at the last two times he ran up big cash piles, 1998, 99, 2000, tech bubble, 2004, 5, 6, when financial engineering was running wild, and that led to the tech bubble bursting and then the great financial crisis. And that was the point at which, after those crises blew in, he deployed the cash with patience and with courage. And I think that's what's really separated him, is that ability to just say, you know what, I don't like what I'm seeing. I'm going to sit it out for 1, 2, 3 years more, in the knowledge that at some stage somebody's going to come on bended knee to me for capital. And, Goldman Sachs were one of those who went to him in 2007-8. And he lent them money, he bought a convertible loan, I think he put equity into business, got a fantastic return. Helped Goldman enormously, but Buffett got a very, very healthy return from investing when, nobody else was, because he had the liquidity and the courage there to do. And I think that's been his greatest secret of all, is not just focusing on reward, but being patient enough to avoid risk but then embrace risk at the right time, at the right price.
Yeah, and I guess that kind of record cash pile is a bit of a signal to the market about what he thinks about probably valuations.
Dead giveaway what he thinks right now, yeah. So
yeah, absolutely. So another key principle of Buffett's is this idea of the circle of competence, the idea that you shouldn't invest in things that you don't know about. And this is a direct quote from Buffett. He says that to be an intelligent investor, you don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. So very much emphasizing the quality of company analysis rather than the number of companies it can apply to. Now, a couple of questions for you. How important do you think that principle is? And how achievable is it in the real world for everyday investors? Because I'm going to give you an example. Most of us, by some hook or crook, whether directly or through a fund, will probably hold shares in Nvidia, one of the recent stock market darlings. But very few of us actually have any real tech understanding to appreciate how good their chips are, what the supply chains are, how the market for those chips, what the demand dynamics are going to look like. So you can't know everything about a company. How much do you need to know about a company to be able to be confident to invest?
I think in terms of the circle of competence, I think it is really important. And if you're not comfortable picking your own stocks, that is no shame. It's time consuming. It's not easy. You genuinely do need to read the report and accounts, and they're getting fatter and fatter and fatter. We're all busy people. It's not everybody's idea of a good time. You might want to go home, listen to a podcast, watch something on, watch a download, watch a film. I get it. So, there isn't everybody like me who really actually enjoys getting stuck into a company cash flow statement. So, and if you don't fancy that, there is no shame in it. You can so if you're not happy doing your own research, no problem. Then you can appoint a fund manager, buy a passive fund, though you still need to research both, or you can find yourself a good financial advisor. So there is no shame in saying this is hard or it's too much time. I'm just not interested. If you want to do it, enjoy it. Circle of competence is really important. I've been doing this for 30 odd years. And I've got a national newspaper column that's looking at individual companies, and there are some sectors I just avoid because I just don't understand them. I've no edge. I'm not an expert on geology, so junior miners and junior oils, no. Chemistry wasn't my strongest set at school. I'm a pretty good history student, wasn't bad at languages. So anything to do with biotech, pharmaceuticals, I'm all at sea. I just don't play because I have no edge, and I could go into something in all good faith, but I've no clue whether something's going well or going badly. I read junior mines statements and junior oil statements about this plate, that geology, this number of grams, and I'm just like, no. I mean, I could probably spend an awful lot of time learning about it, but again, the risks involved are substantial. The rewards could be substantial, but it's not a balance that really, really appeals to me. So that's just one way in which I would go about it personally, but we're all different. What I would say is that if you are going to apply the Buffett principles, Charlie Munger's already spelled out the 4 questions you need to ask yourself in poor Charlie's almanac. So just follow these. Do I understand the business? If the answer is no, walk away or do a heck of a lot of research. Does the business have intrinsic value? Which binds, does the business have a good competitive position? Why do customers and clients go to it to buy that product or service rather than anybody else and pay for it willingly? Does management have integrity? Do they think and act like a shareholder? Does the company come at a reasonable price? And if the answer to all of those 4 questions is yes, you may have found something that works for you. If the answer to any of them is no, maybe file it, put it away, see what's changed in a few months' time.
Yeah, okay. So I think that's a very good way of looking at things and determining whether you should actually be investing in stocks to begin with. And as you say, there are lots of other options, doing it via a fund or a tracker fund where you don't actually have to do the research yourself. Can we turn to another aspect of Buffett's investment style? I think it's probably fair to say this one is not controversial. and that's to buy and hold investments for the long term. So Buffett says his favorite holding period is forever. If you're investing in something, you should be prepared to buy and hold it, even if the market closes down for 10 years. And this seems to be linked to his idea that, ultimately in the long term, the returns that you get from share price converge with the returns provided by the business. So that buy and hold approach, Russ, I take it, you're not going to disagree with that.
I'm not, but it does mean, but again, it does require fortitude and it does require patience. And one of the bases of that is if you go to any financial advisor, they'll say to you, sock 3 to 6 months away in cash to cover your bills just in case something cataclysmic goes wrong, either in your own personal circumstances or your investment portfolio. And Buffett always has had that cash buffer. It just happens to be particularly big right now. So that's the first thing any financial advisor would tell you to do, and something that you can organize for yourself quite quickly. In terms of patience, yeah, Peter Lynch, another legendary fund manager from Fidelity Magellan's, a US mid and small cap manager in the 80s and 90s, he said exactly the same thing. Over time, good businesses can be good investments, providing you pay a sensible price. You can turn a really good business into a bad investment by overpaying for it. You can turn a bad business into a decent investment for a bit if you pay so little for it. But with a bad business, one without pricing power, one with a bad balance sheet, one with crooked management, the clock is ticking. It's working against you. With a good business, with a strong competitive position, with pricing power, with a good balance sheet and management that's fully engaged and incentivized and has integrity, there's no clock ticking. So you can ride through a recession, a storm, a president who rules by social media post or whatever else it happens to be, because the underlying business might not be that desperately affected over time. And if the market loses its marbles and marks the stock down heavily and the business is just the same, that may be an opportunity. So I have a lot of patience with that. If you're looking for a guide, a one-line guide, shareholders' funds and tangible shareholders' funds, tangible equity. Over time, good businesses with solid business propositions that don't dob about with their numbers and start playing around with exceptional numbers and exceptional figures and pretending they're not there, over time, their shareholders' funds will grow in line with profits. And if a business is consistently over time growing its tangible equity, you're probably onto something. There are lots of businesses out there that claim that they grow their profits on a pre-exceptional basis, except the exceptionals aren't exceptional, they crop up every year, and book value doesn't grow. They're generally value-destroying businesses and ones to be very, very careful of.
Okay, so yeah, I think most of us would probably agree that the buy and hold approach is probably the best one to execute. Do you think there are any circumstances where more short-term horizons might be justified? So, for instance, if you're doing maybe with a bit of your portfolio investing tactically, or maybe you've invested in something and it's just done really well really quickly, and you find yourself sitting on a very big profit within a matter of months, and now it suddenly looks like it's perhaps gone from undervalued to overvalued. Do you see that there might be instances where that could be the case?
I think from a risk management perspective, definitely. And in the end, any investor before they set off needs to ask themselves, before they do anything, what am I investing for? What's my goal? What's my target return? How much money have I got? How much do I think I'm going to need to achieve my goal? Over what time horizon? That then sets your annual average return target. And what's my appetite for risk? Best defined as ability to suffer losses while chasing gains. And you've got to answer those 4 questions really, really honestly, because they will dictate whether you do it yourself or get somebody to do it for you. They'll dictate which asset classes work best for you, what type of investment platform and instruments work best for you. So once you've done that, you're on the way. And it might turn out that actually you have a core plan, but maybe a percentage of the portfolio you can use it for. Want of a better turn of phrase, sex, drugs, rock and roll and violence. Something that could really go up a long way, but equally could go to zero or go down a lot. And as long as you're happy with that, then that's fine. And those riskier bets, the ones you probably need to keep a closer eye on. I also agree with your point about rebalancing. If something's done brilliantly, then you might need to de-risk just so you don't become excessively exposed. And I think an annual check of your portfolio, just to make sure you haven't got too much of one thing and maybe nothing else for something else that's working well, but this market just doesn't care, is probably a sensible policy.
Yeah, and I think that buy and hold approach probably also mitigates a bit against the kind of, I guess, human imperative to keep trying to do something, to keep
Yeah,
trading, and also incurring fees as well, right?
they
Which
compound up just like dividends. Yeah.
exactly, yeah. Um, but I guess probably on the flip side of that, maybe also don't be too complacent about your investment. You still need to check in on them and make sure they're doing okay, and have a review every now and again, right?
Yeah, you need to make sure that management hasn't dropped the ball or hasn't done a transformational acquisition, which is probably code for they really, really wanted it and really, really overpaid for it, and they potentially weakened the balance sheet. So those things that you need to keep a check on those 4 questions. Do I still understand the business? If they've done something wacky, they've diversified into something, you need to know why. Golden rule there, if they're diversifying to 2 things at once, different geography, different product, be really careful. If they're diversifying into 1 thing at once, new country, new product, fine. Both at the same time, it's generally a major management headache down the pipe. So that's just those little, so you can certainly test, do I still understand the business? Is its competitive position the same? Look at Porter's 5 forces, the things that are going to affect that. Has management changed? You could have a new management team. Do they behave in the same way as the previous ones? And then you still come back to, is it good value or not? So yeah, definitely keep checking the portfolio against those 4 things. I just wouldn't want to do it every week or every month or even every quarter.
Sure.
I have my financial advisor. I do it once a year. Make sure they've not run off with the money. Make sure that they've not drifted from the mandate that they've been given.
Okay, great. Well, should we maybe turn to a bit more of a controversial aspect of Buffett's approach, which is his insistence on running a highly concentrated portfolio. So, investing in a relatively small number of businesses. He has a pretty extreme view of this, saying that diversification is protection against ignorance, which really cuts across conventional wisdom. He actually writes in one of his shareholder letters, he thinks a policy of portfolio concentration may well decrease risk if it raises the intensity with which an investor thinks about the business, and also the comfort level they must feel with its economic characteristics before buying in. Now, I think this feels like a bit of a tough one. Russ, I'm sure, like me, you've probably spent many years telling people that one of the cornerstones of investing is diversification, but Buffett's telling us totally the opposite. So is he wrong? Are we numpties? What's going on here?
I guess the 2 arguments in favor of what he said. 1, nobody gets rich from their 50th best idea. 2, you look at some of the richest people in the world, they were entrepreneurs, they probably own 1 stock, right? In their company. So that's the argument, but equally, they really, really understand those businesses and are fully committed to them. I think given what we've just discussed about, do we all have the time to really go into the nuts and bolts of all of these companies top to bottom? Possibly not. So I think there is some degree of protection that you seek there. And also you can be incredibly high conviction on something and correct, still get the share price wrong. All it would take right now is a missile landing in the wrong place, or a ship sinking in the wrong place, or a storm in the wrong place. And your carefully crafted thesis on oil or wheat or agricultural companies or fertilizer companies or airlines could prove very problematic in the short term. Now, again, if you've got that cash buffer, that might help. But again, you could find yourself in that wretched position of having just the market go against you, not the business, and be potentially forced out of your positions by financial necessity. And that would be a very difficult one. So I think some degree of diversity protects you from that extreme market action. But ultimately, the best protection against that sort of portfolio pain is to protect yourself by paying appropriate valuations and not just following a good story and paying any old price.
Okay. And just before I give you a bit of a break, Russ, I think we need to talk a little bit about fear and greed. One of Buffett's most famous aphorisms probably is the adage that investors should be fearful when others are greedy and greedy when others are fearful. Now, quite interesting. I actually went back and looked up this quote in a shareholder letter, and it kind of appears in some important context. What he says is that investors should remember that excitement and expenses are their enemies, and if they insist on trying to time their participation in equities, they should try to be fearful when others are greedy, and greedy only when others are fearful. So in other words, the implication actually seems to be you shouldn't try to time the market at all, but that if you feel that you have to, for whatever reason, then make sure that you're going against the herd. So what do you make of this adage, Russ? Is market timing a good thing if you can be fearful when others are greedy? I mean, it's actually a very difficult thing to achieve, probably, isn't it?
It is. I think there's that old saying of the time to when the time to buy the market when it comes, you really won't feel like it because you'll see a sea of red in front of you. Mood follows price ultimately, and that's why you see market cycles, because everybody gets really bullish at the top and takes lots more risk than they would do normally, and everybody gets really bearish at the bottom and take less risk than they would do normally, and that's the opportunity set to get out and get in if you feel it's appropriate to try and time the market. What Buffett will actually try and do is just pick businesses that will sail through any economic volatility over time. And the share price moving up and down is of absolutely no interest to him whatsoever if he feels he's got the right business, the right management, the right balance sheet at the right price. But if you want to start timing the market, then looking at what he does, build up cash as the market goes higher and valuations become less attractive, and spend that cash as valuations come down and become more attractive, then that's the way to go about it. But it takes a lot of courage, a lot of patience, a lot of nerve, and we just haven't all got it, all necessarily the time. You know, the times when the market's rocking and rolling, you and I are so busy, we probably barely get a chance to eat breakfast, let alone go home and study set a report and account to work out whether something's cheap or not. So again, that's the difficulty of it. So his real skill was picking really good businesses that could sail through at share price valuations that enabled him to come through without undue concern. And even then, he said his personal wealth probably halved twice or three times during his lifetime as the market rocked and rolled. So if you wish to try and time the market, trying to do, not necessarily just be willfully contrarian like a Yorkshireman, but try and do it with a method and based on valuation is the way to go about it. But it's not easy to do. And maybe the easiest way is pick the good businesses at suitably low valuations and then switch the screen off for a bit. Certainly on the days when everything's going haywire.
Okay. Well, Russ, that's part one done. Don't go away. We'll be back for part two shortly. But first, let's hear from our guest on this show, Keith Ashworth-Lord. Now, Keith manages the Sanford DeLand Buffettology Fund, which actually invests in Berkshire Hathaway. He's also a keen Buffettologist, as he explained to me earlier. Keith, thank you very much for being with us today. The Sanford DeLand Buffettology Fund, obviously named after Warren Buffett. Why did you name it after Warren, and how exactly did the naming come about? Was it something you always wanted to do? Was it a Greek discussion? Was it a bit more of a kind of a whim? What was the story behind it?
There was quite a story behind it, I can tell. I was in Florida at my home at Christmas in 2009 when I got a call from David Clark up in Omaha. Dale and Mary Buffett and the other Buffettologists, we'd all known one another for about 15 years prior to that. When we going over there, we got to know one another well. They kind of liked my approach. It's very much along the sort of Buffettology tram tracks. And Dave said, have you ever thought about starting up a fund of your own? And I said, funny you should ask that, Dave, because that's exactly what I'm thinking about doing at the moment. At the time, I was working as a consultant to a variety of businesses. And the idea that to set up my own fund was something that I'd been thinking about for a while, because I've had a lot of success with this method of investing for my own private pension fund. So the key thing was Dave said to me, well, as you know, we've done the Buffettology series of books. We said, we've trademarked the name the world over. He said, and what we have in mind is a European fund. And we would like you to think about managing it because we know you walk the walk as well as talk the talk. And if you did, we would license you the name Buffettology on an exclusive basis for a 10-year period. So I immediately thought, that's the name over the door. I can see now that's going to give me an edge because, I mean, this business is so competitive, and especially when you're starting out. So that was the genesis of how the Buffettology name came. I mean, and obviously, before that, it was the series of books that Mary and David had written and published together.
You mentioned the UK there. That's where you invest predominantly. That's obviously very different to Warren Buffett, to his Berkshire Hathaway vehicle. Are there any specific challenges or perhaps benefits that you see in applying the Buffett approach to the UK stock market?
I think the key thing there to be honest, is you've got to be confident about the jurisdiction in which you're operating. So you've got to be confident about the accounting standards, the law, the customs, that type of thing. And that would, I think, necessarily exclude a few countries, but certainly that's not true of the UK and the US. It's so long as you're happy with, as I say, the jurisdiction, you're looking for the same traits in businesses. The high returns on equity, the high cash conversion, the great margins, the walls, drawbridges, and moats around the business. It's the same search. And we find them. We found them in the US. We've held a business called Rollins, which is a pest control business in the US. We've held that for many, many years. It's been very successful, actually. And that conforms to all the criteria that we look for. We hold Berkshire Hathaway itself in the fund, again, have done for a long time. So there are ones overseas that we find. The only problem we have is because we operate under the UCITS regulations, 80% of our portfolio has to be in UK equities at any one time. So that means the overseas equity interests we have, plus any cash we have sitting around waiting to be invested, they count in that 20% bucket. And that is definitely a limiting factor. That has been the limiting factor on why we've stayed mainly in the UK, because it's not that we've not found opportunities in the US as well.
Okay. And if you look at what Warren Buffett does at Berkshire Hathaway, as far as I'm aware, he doesn't hold any UK stocks. It doesn't seem to be a market that he's generally been heavily invested in. What do you take from that? Is it because it's just a different jurisdiction, as you say? Is it because his amount of money that he's investing is just so large that he can't find the right size companies over here?
That's that. To move the dial, it's got to be a pretty big company these days. I just don't think there are the opportunities in the UK. And also, of course, I mean, if it's a quoted company, he's not particularly big on taking over quoted companies. Not least because they tend to be rather more highly valued than if you can pick off a private one. So I mean, you look at the UK and what could you reasonably buy that would move the dial? Well, probably Bamford and probably Dyson, and much else at the moment. So certainly anything I've identified that I thought would be suitable for Berkshire has really been on the small side. So I think that's the main reason.
Okay. And in terms of your fund, it's launched in 2011. It's got a very good long-term track record, but I think it's probably fair to say it's struggled a little bit in recent years. Would that be fair?
Absolutely. 2022 we describe as our annus horribilis, with a tip of nod to the Queen in 1992 there. What went wrong in 1992 was nothing to do. Sorry, I apologize. In 2022. Was nothing to do with the companies themselves. They were all reporting excellent results. This has been the case all the way along. Very few sort of missed the marker. Most are in line or better than expectations. But the key thing is they've been worn up to such valuations that the Ps were exposed, and we saw a savage contraction in multiple in that particular 12 months. Not untypically, anywhere between a third and even up to a half contraction. Now, the problem we had there was, I mentioned earlier that we can't go to too much cash, otherwise we breach the UCITS rules. So if we've been selling things or selling them down, we'd have had to have bought something else to take their place. And literally the whole market was expensive at that time in the sort of quality growth compounding businesses that we love and adore. So that was, we ruined them, and we were watching the multiples contract, and that was a very, very painful period. And it continued from 2022 into 2023. Well, I think it's fair to say not at the same pace. The other thing we've had to cope with, this is more recently, and like the multiple contraction, it appears to now have run its course. The other thing was we had about a third of the portfolio invested in AIM companies. And the performance of AIM companies across the board since the Labour government threatened and then got IHT relief has been woeful. We had we've had 6 to 9 months of real woeful performance out of those AIM companies, and it was very clear that our other businesses with full listings were performing much, much better than the AIM ones. Now, that appears to have run its course, and thankfully, in the course of the last 3 to 6 months, we have started to slowly pick up in our performance. We're back on first quartile over 3 months, second quartile over 6 months. So I don't want to suggest that it's the turning point or anything like that, but it's a little bit easier to live with than the previous two.
Well, I was going to say there's a budget coming up in October or November, and they've already set a precedent for cutting the IHT relief on AIM, haven't they? So it's possible they might come back for another swipe. But in terms of the rest of the portfolio, you've got Berkshire Hathaway, as you noted. What's your thinking on Berkshire Hathaway now that Warren Buffett has announced that he's stepping down as CEO? And what do you make of his successor, Greg Abel? He's going to be CEO. There's been a lot of talk about how he's been with Berkshire Hathaway for a fair time, but perhaps he's less of an investor and more of a kind of deal maker, operations type guy. He used to be CEO of one of the energy companies that Buffett held. What's how do you see the takeover?
I think the key point here is that it's been long in the planning. It's not something that's happened overnight. And Greg Abel, I think you're absolutely right. Operationally, I think he's a first-rate guy. He's a hard taskmaster. He's got the respect of his managers. What I don't see in him is the sort of financial deal-making finesse that characterized Buffett and Munger. I mean, I think that was a genuine one-off, one-off event or one-off experience. The other side of the succession, I think, is that Ajit will still be in charge of the insurance operations. Now, Ajit is in his 70s, so question mark there about how long would he continue. They've brought Todd Combs and Ted Wetzler on the investment side, and they can take care of that, I think. And then looking further afield, when Warren finally ceases to be chairman, his son Howard will take over as chairman. I think Howard's job will be to preserve the culture of the organization and to make sure that doesn't drift. So I think there's a lot of planning gone in place. He's got a very quirky group of shareholders who accept this business model, whereas some of Wall Street, I think, sometimes takes a deep, sharp intake of breath over it. And I think as long as the results are okay, and the performance continues the way it is, I don't see there being a threat to the business carrying on. But what I do wonder is about the deal-making ability. It could well be that there's about 350 billion of cash sat there waiting for a home. That could well be deployed into a buyback. It won't at the present valuation, because I just think it's too much of book value to really do a buyback at these levels. But it's certainly there. If something were to happen, the share price were to take a tank, then I definitely think that's a possibility. And the other thing is that Buffett has always been at his best from hard times. You think back to some of the sweetheart deals he did to save businesses in the great financial crisis. There's always been some great deals on the table when effectively he becomes the lender of last resort. So I think if we were to fall upon very hard times economically again, I think there will be opportunities there for doing some pretty smart deals.
Yeah, for sure. And they have got this huge cash pile. I've read that it's a record cash pile for Buffett, for Berkshire Hathaway. Do you think that tells us that we should, as a whole, all of us, be cautious about markets, that Warren Buffett isn't finding good opportunities to go into with that cash?
I go back to the AGM of 2024 when he expressly said that they were finding opportunities on the ground very difficult to find. And this was at a time when UK asset allocators were selling up over here and headlong going into the US market, and tech stocks in particular. And I remember having the discussion about, well, who would you put your money behind, the US UK asset allocators or Warren Buffett? I know where my money would be. So I do think he expressly said it was not a call on the market, this enhanced liquidity. But I do think you have to take cognizance of it and think, yeah, there probably is something there at the back of the mind that things are just a little bit overcooked.
Yeah. Okay. And just finally, you obviously kind of apply the Buffett approach in your investment strategy. Do you find it entirely consistent and without conflict? Because he's written a huge amount of stuff over the years, and there are just certain things that sometimes he says that seem to be in conflict with each other. I mean, an example would be, for instance, talking about diversification. He's not a huge fan of diversification. I think it's fair to say most of us, kind of in mere mortals, say diversification, it's the only free lunch in investing. So there's that aspect to it, but also at the same time saying most people should own a tracker fund, which kind of sets itself up against active management, doesn't it? Of which he is one of the greatest examples. Did you find that there are kind of things like that where you think you have to do a bit of interpretation of what he says rather than just it's something that you can just take off the shelf and apply it?
I think that is a very, very fair comment. If we look at the diversification angle, you're quite right. He says it's basically a hedge against ignorance, and I think what he's saying with the tracker fund thing is that most people don't have the skills to invest, and certainly not to invest on a highly focused way. So I think he's fine doing that, and I'm fine doing that. I mean, I've got what is it, 27 companies in Buffettology at the moment. That's too many. If the rules, I'd prefer to have about 15. It's that Buffett once said you should have a card for your investment life, and every time you do an invest, it's a clip off one, and you've only got so many clips. That's kind of how I feel about things. So I think for him and for people wired like that, and I think I am on those sort of tram tracks, for want of a better word, I think it's fine. Concentrated portfolios, let your skills at finding great businesses reward over time. But I think for ordinary people, Joe Public, I think that is a far different call, and they will be far better off with the safety of a more diversified portfolio around them, because I just don't think they would have the mindset, maybe the skills as well, but certainly the mindset to run a highly concentrated portfolio with all the volatility that is involved, and also the fact that occasionally you might get the odd bad egg or two that goes wrong on you. So I can see why there's that dilemma or that dichotomy. But I think you're absolutely right that those two statements don't stack up quite against one another in the fullness of the canvas.
Well, all part of being an enigma, I suppose. So it's been really interesting to talk to you. Thanks very much for joining us, Keith.
Thank you very much.
Okay, many thanks to Keith Ashworth-Lord there for giving us his insights into the science of Buffettology. I've still got Russ Mould here with me, and we were just talking about fear and greed. And, I guess part of that, Russ, is that, sometimes markets get carried away from themselves. They're not rational, they're inefficient. And Buffett is definitely of the opinion that markets are not totally efficient. I think he thinks they're largely efficient, but not totally efficient. But as I touched on there with Keith Ashworth-Lord, one of the oddest pieces of advice to come from Warren Buffett, who is, let's face it, one of the most famous, if not the most famous, active money manager of all time, is his assertion that the vast majority of retail investors should simply buy a tracker fund. Now, there's a couple of kind of conflicts there, aren't there? It sits quite uncomfortably with the idea that diversification is protection against ignorance, because what could be more diversified than a plain vanilla tracker fund? And it's also a bit weird coming from an active manager who's doubled a return from the S&P 500 over 7 decades and holds this, Woodstock for capitalists, this big shareholder meeting, many of whom the people flocking to that are retail investors. Why did he not just say, well, invest in Berkshire Hathaway rather than the market? So, Russ, I'm really interested to hear where you stand on this. Do you think it's right? Should the vast majority of people invest in a tracker fund, steer clear of picking stocks, and even steer clear of active money managers like Buffett as well?
I think he's probably politely saying that a lot of investors may not have the time or the expertise to really, really look after them. So, and he knew, he says that, he and Munger used to say that in many ways the investor's biggest enemy is themselves. Because as you say, we're hot-wired to do things. We're hot-wired to look for narratives. We're hot-wired to action. And that's largely an evolutionary thing. And if a saber-toothed tiger came around the corner, you and I would run like hell. But all you have to do is outrun me. You don't have to outrun the saber-toothed tiger. And believe me, you'd outrun me, so you'd be absolutely fine. So we're hot-wired to run away from the burning building, the tiger. Investment, you're supposed to run toward it, because that's when people are distressed and frightened, and when the danger is at its highest is when things are at their cheapest, and we're just not hot-wired to think that way. So given that, and if you haven't got the time or the expertise to go through company report and accounts and find where they're burying the stuff, the bad news, or even just look at the fact that the book value hasn't grown for 20 years when they claim that profits have, then maybe a passive option is for you. Now, again, the other layer to this is there was no greater champion of America than Buffett. He didn't invest much overseas. I know he's dipped his toe in Japan in the past 2 or 3 years to fantastically good effect, but he was generally a great believer in America, the American dream, and capitalism, and the American version of capitalism. That doesn't sit well with everybody philosophically, financially, but he was a big believer in. So I think he was certainly very happy to champion an S&P 500 tracker, whether it be so wild about one that was tracking a niche sector like robotics or space that's just gone through the ceiling, or even, dare I say, a country where he felt that the economics and politics weren't quite as conducive to his views as those of as America, I guess is a different question. But over time, betting against American exceptionalism has not been a smart thing to do. Over time, betting against human ingenuity has not actually been a smart thing to do. COVID-19, whatever you think of it, conspiracy theory or panic or something that was really, really serious, a vaccine popped out within a year and it's eventually gone away. Now, we can debate the whys and wheres of it, but it's a relatively recent example. And over time, betting against human ingenuity and solutions is not proven to be a success. That said, it sometimes does take a crisis to force those solutions and that ingenuity to come into place. And if anything, the last 15 years of cheap money, fuzzy money, QE, ZERP, and everything else has probably dulled the crisis, meant that we've gone and bodged our way along rather than perhaps forged a more lasting solution. But that's probably a separate issue. So I have every understanding of why he would say to people, if you don't like this, you don't have the expertise, you're inclined to take more risk than you realize, then passive might work for you, but you still need to research what's in the passive instrument. You've already mentioned NVIDIA. The S&P 500, 1/3 of its value is in 7 companies. So you'd better know what they are and what they do. And so if they were to start falling by the wayside, I'm sure other things would pick up, but it could get a bit bumpy in the meantime. So again, you'd need to know what's in there and why and what the possible mechanics of it are. But it keeps your costs down. It keeps you in the game over the very long term. But just as a passive fund will follow things up in lockstep minus its fees, it will also follow them down in lockstep minus its fees. And you've just got to be mentally and financially prepared for that, because it can and probably will happen at some stage.
Yeah, and I think, certainly, recent fund flow shows that actually a lot of retail investors are following this advice, because there's lots of money, particularly in the UK, flowing into tracker funds and money coming out of active funds as well. And this is true. The US is a bit ahead of us in this respect. I noticed that I think it was last year, the amount of money held in passive funds in the US actually exceeded the amount held in active funds. And it's quite interesting, isn't it? We do a report every now and then called a manager versus machine report, which looks at active versus passive funds. And we do it every 6 months. And by and large, the percentage of active managers who outperform is generally somewhere between 30 and 40%. It's not a hugely reassuring figure for active managers. But I do sometimes wonder, Russ, how much of that is being driven by this dynamic of money going into passive funds, and those passive funds are allocating money to the biggest companies in the market, and that's driving the performance of those companies. The passive funds performance starts to look better, and people start investing even more. Do you think that's kind of an issue, and maybe tied to the issue of kind of valuations at the moment as well?
Yeah, I think having been working in markets for 35 years now, I think there is a degree of reflexivity in markets that wasn't there when I started, in that, yeah, as you said, fund flows in, money goes into passive fund. Passive fund buys the stocks that are based in that index. Index goes up. Index weighting goes up in global portfolios. Rinse, repeat, round and round we go. But as we saw in 21-22, it can work in reverse. So again, it's not necessarily always a virtuous circle. It can become a vicious one, which is why we do need to be still cognizant of things like valuation. The S&P 500 is looking expensive relative to its own history on most metrics that you can slice or dice. But you could argue of that it's been the case for a very, very long time. What you haven't had is the shock that has made people decide they don't want to be there. At the moment, people are happy to embrace that risk. What you're always on the lookout for is what might change their minds. COVID did for a bit, but not for very long. Higher interest rates in 2021-22 did for a bit, but not very long. Trump trade and tariffs did it for about a week. Let's see. In the end, what would really upset the apple cart is if we get a slowdown, a recession, and corporate earnings don't go up and start going down. That's the secret to it. And if you see any hints of that, falling corporate earnings would be problematic. Yes, I'm sure central banks would respond with interest rate cuts really quickly, but that didn't save the bacon in 2000 to 2002 for 2 years, and it took 18 months for it to work in 2007-8. So again, that's when you'd have to be tin hat on, screen off, ride your way through with your cash buffer behind you, and that's how you'd get through it. But there will be a time, I'd be mightily surprised if we didn't see something similar like that at some stage.
Yeah. Okay. And I think also the other thing just to say, probably just finally on this issue of the tracker funds, is that actually there isn't this dichotomy between investing in tracker funds and active funds and shares. Actually, you can do all of these things, right? And we've talked a little bit already about the circle of competence and how difficult it is to run a portfolio of shares. I think if you're running a diversified portfolio of shares, Russ, what would you say? Normally 25 to 30 shares minimum. That's probably a very highly concentrated portfolio that you need
that's
to hold.
That's going to be quite hard to run and keep your eye on.
Exactly, but I often think quite a good shortcut to that is that you hold the bulk of your money in like a passive tracker fund.
There you go.
And then you can explore a little bit with a smaller part of your portfolio and generally build your knowledge. And if you get to a point where you are running a bigger portfolio and you've got a bit more time, then
I would maybe probably say no more than 10 or 12 different industries anyway. Put it that way.
Yeah. But so you can just blend all these things together. They're all investment vehicles.
Right.
You don't have to choose active or passive. You can have a bit of both.
I think that's a great way.
There are some areas, like smaller companies, reducing risk, producing income, where actually kind of an active strategy is probably preferable, and actually those areas don't tend to be well served by passive funds. So I often think in industry we often think of it as a dichotomy and active and passive, but actually if you're a retail investor you have access to both.
That's fair.
Yeah. Well, let's turn to a subject close to your heart, Russ, as the author of AJ Bell's Dividend Dashboard. So like you, Warren Buffett relishes the dividends that are paid by his portfolio of businesses, though interestingly Berkshire Hathaway itself doesn't pay a dividend. When you think about dividends, Russ, how important do you think dividends are as part of an investing strategy? And if I can ask you to answer that question, both in terms of obviously kind of if you're looking for an income strategy, it feels fairly straightforward that dividends are important. But perhaps if you could also just talk to if you're just trying to grow your wealth as well.
Yeah, again, it comes back to those 4 questions. Why am I doing it? What's my time horizon, target return, and appetite for risk? But I think dividends mathematically over time are proven to be a big percentage of your total return. If you reinvest them, then you really do get the benefits of compounding. Now, your personal financial circumstances may mean you want to extract those dividends and not reinvest them. So that's all part of the thinking. You may need to think about your tax situation and the vehicles in which you hold those dividend paying, whether they're stocks where they're tax efficient like an ISA and a SIP, or less so like a general investment account, for example. So there are lots of other considerations there. But over time, dividends are a very, very powerful tool. And I think what I would particularly focus on, if you're looking for capital gains or a mix of gains and income, growing dividends are a really, really powerful sign and a powerful tool. A company's got to be really good to be able to grow its dividend consistently without straining its finances. There's 17 firms in the FTSE 100 that have grown their dividend every year for the last 10 years. It's not easy to do. I know we've had COVID mucking things up in the middle. Those 17 still came through it, but it wasn't easy. So, and over time, just think about it. If you and I come across a company whose share price is £1 and the dividend is a penny, you think, okay, well, let's have a look. From an income perspective, you'll probably nod off. But if it increases that dividend by 1 penny a year every year for the next 10 years, and the dividend is then 11p, I can almost guarantee you the share price isn't still going to be £1.
Yeah.
Unless something has terminally gone wrong with that business. Now, what I would say is we all can look for a high yield stock. Generally speaking, high yield stocks are mature, probably not growing very much. It's no crime, but you just need to be aware of that. But it's also the stock market's way of saying there are some risks associated with this business and I want to be compensated for them. And the yield is part of that total return. You know, tobacco is a classic example. Those stocks have done brilliantly over the last year and a half because the cash flow that every fall would wither is still there. Jacked up their prices and slashed costs. You might think, I don't want to invest in tobacco stocks. It's all nasty, stinky things. Don't believe in it. Dirty business. Well, an ethical point of view, that's down to the investor. Somebody who just believes in nickels and cents, dollars and dimes, well, they might be more interested. But you demand that high yield because of the risks you perceive from a regulatory or other perspective. And sometimes that high yield can be a millstone for the company because, you know, if you cut that dividend, your share price is going to collapse as well. Yeah. So you get capital pain to add to dividend insult. So again, you've got to be very, very wary there as well. So
probably particularly with companies that are economically sensitive. So things like mining companies, oil companies, right? You know, they are price takers, aren't they? So
yep.
You know, very high dividend yields from those companies can find themselves slashed very quickly.
Yeah, and we've seen multiple examples of that. Miners is a brilliant example. Rio Tinto is still paying a decent dividend yield, but it was paying out special dividends for fun a couple of years ago. So again, if anything, with cyclical companies like that are price takers that do well when the economy is on the way up and less when the economy is on the way down, a high dividend yield from them is probably a warning sign.
Yeah.
Airlines, tricky business. Tend to be stocks to trade and rent rather than own, to go back to our prior conversation. And generally, when they start doing dividends and share buybacks in great size, we're probably nearer the top of the economic cycle than the bottom, if history is any guide. Now, that's not advice, I hasten to add, but it's the sort of thing that you need to watch out for, is that businesses that can be boom and bust, when things look like they're booming, they pay out great dividends, you just need to keep twice the eye on them that you did previously.
Yeah. I mean, what would you say to the opposing view, Russ, which I think is probably quite prevalent in the market today, particularly with, you know, the kind of big tech companies, which is that basically if you've got a company that's paying out dividends, it's a mature company, it's got limited growth prospects, and it's got no idea for reinvesting those for growth. What do you kind of say to that opposing view to you know, really relishing and valuing dividends?
I can understand that, but then in which case I'd love to know why Apple's on 25 times earnings, because it fits that bill exactly.
Yeah.
I mean, it's a thought-provoking debate, right? Apple's sales haven't grown for X years. Its earnings per share are basically growing because of share buybacks. And Apple is returning lavish amounts of cash through buybacks and dividends. So Microsoft is. So again, you do need to think about what multiple am I paying for some of these businesses. If that is indeed the case, you factor that into your valuation as framework as best you can.
Yeah, and I guess there's perhaps there's possibly a sweet spot in between kind of high yield and growth where you want to be.
Probably right.
And also perhaps having, you know, we said it earlier, a diversified portfolio.
Yeah.
Where you've got a bit of all of these companies, right? Where you've got your growth, your kind of growth and income, and your out and out income perhaps, and you've probably got a good spread there. I think
that's probably a good way of looking at it.
Yeah. Can we talk about Coca-Cola now?
I don't drink it, but by all means.
You might not, but Warren Buffett apparently drinks five cans a day.
Yeah.
So yeah, he's a big fan of Coca-Cola. It's one of his favorite stocks too.
Yes.
And it's one of these things that he calls the inevitables, which are basically companies that are global leaders. You know, he thinks they can be expected to dominate their fields for an investment lifetime. Another example that, you know, he's given is Gillette, which is now part of Procter and Gamble. I guess other things that he holds that might fall into this category are probably Kraft Heinz, American Express. So, you know, global brand leaders. What do you think, Russ, is attractive about these stocks? Is anything attractive about these stocks? And perhaps is it a bit complacent to call them inevitables?
We used the word earlier, and it's franchises.
Yeah.
It's companies with strong competitive positions, and therefore they have intrinsic value. because they have pricing power, they generate cash, and that cash can either be reinvested in that business to build what Buffett calls, unbreachable castles with unbreachable moats, or if that cash can be returned to shareholders once that competitive position has been protected and deepened. So yeah, I think what's Coca-Cola got? A fabulous brand and a product that brings a lot of people a lot of pleasure. Perfect. What else can you look for? You look for brand, you look for technological edge, you look for market share, you look for an installed base of kit that you can just send somebody to maintain every year at very high margin. So those are the sort of franchises that you're looking for. Or even, dare I say it, Buffett's been pretty good at buying things that are almost monopolies, if not oligopolies. Think railroads, think electrical utilities. They're perhaps regulated monopolies even. So you know what demand you're going to get, you know what your customers are, you know what the pricing is going to be, then you're relying on management to run the business properly, and you're just making sure that there isn't some sort of creeping change in technology or market coming up behind you that renders this stuff obsolete. But I don't think you're going to see that even with a humble railroad for a while right now. So he was probably just as much a franchise picker as a stock picker. One or two of those you could argue we got wrong. Kraft Heinz hasn't worked well, but that was highly acquisitive and used a lot of debt, which again, things that we cautioned against earlier. Lubrizol, he possibly overpaid for it, but again, that seems to be bouncing back a little bit now. So even he didn't get everything right. Berkshire Hathaway was one of his worst investments. It made suit linings. It was a terrible business. Nobody buys a suit because it's got a Berkshire Hathaway suit lining. They want to buy a suit because it's made by Paul Smith and it fits all out, however. And he kept the name Berkshire Hathaway to remind him of the fact what a bad investment it was, and it kept him humble. So I think franchises is the words, and those are some of the facets that you can see that then turn into pricing power, high margin, strong cash flow, scope to reinvest, scope to pay dividends, return cash.
Okay. Let's have a look at a bit more of a technical one, shall we, for the boffins out there. Buffett doesn't like EBITDA as a measure of company profitability.
I won't say what Charlie Munger wrote about it, but it involves a cow's bottom.
Right. Okay. Well, I've got a feeling I know what you will think about this, Russ. But what is EBITDA? And is Buffett right to rail against it quite so passionately?
EBITDA is earnings before interest, taxes, depreciation, and amortization. Now, depreciation and amortization are accounting constructs designed to try and measure and calculate and quantify the amount at which brands wear out, intellectual property wears out because of obsolescence, and physical assets wear out. Mm-hmm. So that's why you often look at the capex to depreciation ratio. Is a company properly replacing the assets to make sure its kit is nice, new, shiny, and competitive? So depreciation and amortization, they're subtracted from profits, but they're non-cash items because they're an accounting construct to try and reflect this issue. So you can argue if you add them back, you're looking at a proxy cash flow for the business, which I understand, because cash flow in companies can make lots of profits but not generate any cash, and they're generally things to be very careful of. Mm-hmm. However, the problem that you have with EBITDA is that as equity investors, we don't own the EBITDA. Because if you look at the profit and loss account, what do you own as a shareholder? You own the net. Because if you look at the pecking order of creditors, 1 to 9, if a company goes bankrupt, as a shareholder, you're bottom. You're way behind the banks who own the interest. You're way behind the tax man who owns the tax. So looking at earnings before interest and tax is entirely pointless, because if my company my investee company goes bust, I'm down the pecking order. I might get a few pence in the pound if I'm lucky. Probably zero. I, as a shareholder and equity owner, own the net. So EBITDA is no use to me at all. It's of interest to the banks because it often sets the covenants for lending and bonds, and that's absolutely fine. It's of interest to the taxman, maybe, because they're waiting for their tax. No use to me. So unfortunately, from a shareholder perspective, we really need to focus on the net profit. Okay. Literally the bottom line.
And I guess, Russ, all financial statements will provide that bottom line.
Yes.
There's perhaps a question about the emphasis that management puts on EBITDA versus those.
It's nearly a bigger number for a start, so it always sounds better. We're in the black in EBITDA. You can still be losing money. Ocado claimed it's in the black in EBITDA terms, and it's losing money hand over fist, which may be why its share price has gone from 28 quid to about 2. Eventually, the market will see through you.
Yeah. Okay. I think you mentioned sex, drugs, and rock and roll earlier, Russ. We're probably going to end on that because the last subjects that we're going to cover in terms of Buffett's investing tips really are derivatives and crypto. So again, these are things that Buffett really doesn't like.
Just have a stiff drink. Keep going.
Yeah, okay. You open that bottle. He's called derivatives weapons of mass destruction, and crypto rat poison squared. Let's start with derivatives, Russ. Is it fair to call them weapons of mass destruction because they're very widely used in the financial industries? In many ways, in fairly plain vanilla ways.
They're used for hedging in a very vanilla way. Yes. Yeah. You can actually go to, I think, the US regulator, is it the OCC or one of the US regulators or FINRA, and look at what the global derivatives exposure is of the American banks, and it's in the trillions of dollars. Mm-hmm. Now, they will argue they all net off very neatly, right? If one of your counterparties goes bust during a financial crisis, I don't think they net off quite so neatly. So I think that's the issue. And we saw derivatives play a massive role in the 2007-9 financial crisis.
Yeah.
If you go back before that, I recommend that you read Richard Buxteber's book, Demons of Our Own Design, which is magisterial on all of the financial crises from the early 1990s through to the great financial crisis. And he says that basically you need the same things in place for a crisis to slowly develop and then eventually. And they're effectively leverage, debt, derivatives, and opacity, lack of transparency. And derivatives are traded OTC, they're not over the counter, they're not traded on an exchange. They involve magnifying returns and therefore potentially magnifying losses. So they tick both boxes. And while they can be perfectly liquid and tradable when markets are functioning properly, if anything happens and that liquidity dries up. So it's like anything else. They look brilliant when things are working well and an awful lot less brilliant when things are working badly. And
they're hugely complex, aren't they? And that was one of the problems of the financial crisis is no one really understood the chain of events that might be sparked by a movement in the US housing market, as it turned out, and what effect that might have on the wider market because of derivatives.
Yeah, and I think they are complex. They provide they can multiply your returns, but they can multiply your losses, and they are really truly for expert investors only, and they need to be monitored incredibly closely. You almost do need to stare at your screen all the time, which I'm sure for your mental health is probably not a brilliant thing.
Yeah, not fun for all the family. Okay, well let's finish on crypto. It's, one of the big booming assets of our time. Pretty sure I know where you stand, Russ. What's your view on crypto?
I mean, again, I'm not allowed to get involved, but if I was permitted to get involved, I wouldn't, because I don't understand them and view them as beyond my circle of competence, and I've no fear of missing out.
Okay.
But I think that's where I would stand. I think I could see the logic behind Bitcoin when it started, supply capped at 21 million, in a world where central banks were conjuring money out of thin air. There was always an inflation risk. I get the store of value concept to a degree, but I think it's been undermined by the fact that you can go to coinmarketcap.com and look at how many different cryptos are out there. There's a limitless supply of these things. So that argument's shot straight down. What is money? It's a unit of account, it's a store of value and a medium of exchange. The store of value thing is undermined by the fact these things breed like rabbits. The unit of exchange thing, nobody uses it to go shopping with. Unit of account, maybe, I guess. So I think it fails two of the three tests in terms of whether it's money. I think the original argument for it being outside the system was strong. I'm now fascinated to see that everybody's clamoring for these things to be regulated and be inside the system. Well, why is that? You've changed your tune. Is it just number go up? I think it is number go up. I think it's just looking to draw in more buyers. And that means it's almost a Ponzi scheme. Sorry. So I think I'll be a little bit wary of that. So I think the fact that the story has changed from it's money to it's a store of value to we don't want it regulated, it's out beyond, and all of those things have been chipped away. It's not encouraged me to look at it more deeply and try and improve my understanding, because the story's gone away from what it was originally, and I've no fear of missing out. But I have to accept it has a value because people are giving it a value.
And a huge industry now, right? I mean,
the Kardashians are famous because they're famous, and Bitcoin's got value because people think it's got value, and I have to accept that. Again, it's the Buffett thing, right? It's kind of, the market is inefficient and it isn't always right, but its views have to be respected, because there's a lot of people out there looking at this stuff and they're smarter than me. So I'm gonna take that one on the chin. But I think it doesn't. If I was allowed to do my own investments, it wouldn't pass the tests that work for me in terms of what's my goal, my appetite for risk, my target horizon, and my time horizon, my target reset. Wouldn't fit. So I would just park it. If you want to get involved, you have to know why you're doing it, what the risks are, and all those other things. And if you want to read some really interesting stuff on Bitcoin, go to the Owenomics blogs on Arcadian Asset Management. You want to know about risks of Bitcoin? The number of Bitcoin millionaires who publicly said they're Bitcoin millionaires who've been ransomed, hijacked, had their fingers cut off so people can get to their Bitcoin keys. That's a risk that worth thinking about. Anything that criminals quite fancy using, you might not want to own, is one of his arguments.
Yeah. And I mean, yeah, definitely not an asset class you probably hold if you're trying to invest like Warren Buffett.
No.
Although, millions of people in the UK do.
And now I'm sure they've made some money out of it and can look at me and say, well, you've missed out. But I have no fear of missing out. No, that's one of my many weaknesses I think I have conquered at least.
Great stuff. Well, thanks very much for all of that, Russ. Really, really appreciate you being here. I do feel like we could have got a whole podcast series out of this subject, actually, but we'll leave it there for now. If you've enjoyed this podcast, then please do rate us on Apple or Spotify or wherever you get your podcasts, as it helps other like-minded listeners find us. The main AJ Bell Money and Markets pod is going to be back later on this week, but that's it from us for now. Thanks for listening. We'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.